In the early hours of a cold October morning, while most of the world slept, the global financial system hovered on the edge of annihilation. Banks that had stood for more than a century were seconds away from failing. International payment systems were freezing. Governments were staring at screens filled with numbers that no longer made sense. Trillions of dollars' wealth accumulated across generations were evaporating faster than anyone could measure. This was not a war. There were no bombs, no armies marched. Yet the danger was just as real. At the center of the storm stood the United States, terrified, exposed, and facing a collapse that could take down the entire global economy. But what followed in the weeks and months after this moment would quietly redraw the balance of power between America and Europe in a way most people never fully understood. Publicly, the narrative would be simple. America acted decisively. Markets were stabilized. The system was saved. Privately, something far more consequential was happening. A series of emergency financial actions coordinated behind closed doors between central banks, treasuries, and political leaders would protect the American financial system at all costs. Liquidity would be flooded into U.S. markets. Dollar shortages would be relieved. Major American institutions would be rescued. Europe, however, would not be spared. While headlines spoke of global cooperation, the reality was asymmetrical. Capital flowed toward safety, and in moments of existential panic, the world still defined safety as one place above all others: the United States. As the crisis deepened, European banks found themselves bleeding dollars currency they desperately needed to survive. European governments were forced into impossible decisions: austerity or collapse, bailouts or political suicide. Some would choose rescue, others would choose restraint. All would pay the price. This was not an accident. It was the consequence of a financial system built after World War II, a system where the dollar sat at the center, where America's stability became the world's lifeline, and where any shock would inevitably strengthen the core while weakening the periphery. By the time the panic subsided, America would emerge bruised but intact. Its banks would survive, its financial markets would recover faster than anyone expected. Europe would not. What followed was a decade of stagnation, debt crises, political radicalization, and a slow erosion of economic sovereignty across the continent. Entire nations would lose control over their budgets. Governments would fall. Trust in institutions would collapse. And yet, most people would never connect these outcomes to the decisions made in those dark weeks, when a secret bailout saved America, and in doing so, quietly destroyed Europe. To understand how this happened, we must return to the moment the global system broke hand. Examine who was rescued first, who was sacrificed, and why. Long before the crisis erupted, the fate of Europe had already been sealed not by reckless spending alone, not by political miscalculation, but by a quiet dependency that few truly understood. At the heart of the modern financial system stood a single currency, the U.S. dollar, after World War II. The world rebuilt itself around American financial power. The Bretton Woods system placed the dollar at the center of global trade, global lending, and global reserves. Even after the formal gold link was abandoned in the 1970s, the structure remained. Oil was priced in dollars. International debt was issued in dollars. Global banks borrowed and lent in dollars. This arrangement worked until it didn't. European banks, in particular, became deeply entangled in the dollar system. They borrowed short-term dollars from U.S. money markets and used them to fund long-term investments across Europe and beyond. Mortgages in Ireland, real estate in Spain, government bonds in Greece and Italy. The profits looked safe. The risks seemed manageable. But there was a fatal flaw. European banks could not create dollars. Unlike the United States, which could rely on the Federal Reserve to act as lender of last resort, European institutions depended on access to U.S. funding markets. As long as confidence held, this dependency was invisible. The system appeared stable, almost elegant. Then confidence vanished. When the financial panic hit, U.S. money market funds stopped lending overnight. Dollar funding evaporated. European banks suddenly faced an impossible situation. Massive dollar liabilities, but no access to dollars. It was a silent crisis, and it spread with terrifying speed. Banks that appeared solvent on paper were suddenly illiquid. Balance sheets froze. Interbank lending collapsed. Without dollars, European financial institutions could not roll over their debts. Failure was imminent. This was the moment the Federal Reserve intervened. Quietly, without public debate, the Fed opened massive dollar swap lines with select foreign central banks. Trillions of dollars were made available temporarily to prevent a total global meltdown. But access was not equal. The largest and most strategically important European banks were stabilized just enough to avoid immediate collapse. Smaller institutions were left exposed. Peripheral countries, those already burdened with debt, were given no direct relief. This was not charity. The Federal Reserve's priority was clear: protect the U.S. financial system by preventing foreign collapse from ricocheting back into American banks. Europe was stabilized only to the extent necessary to shield America. Meanwhile, capital flowed in one direction. As fear gripped investors, money fled Europe and rushed into U.S. Treasury bonds. Yields collapsed. America borrowed cheaply. Europe paid a premium. The crisis strengthened the dollar, deepened European dependence, and locked the continent into a cycle of austerity. The trap had snapped shut. Europe could not print dollars, it could not inflate its way out, and it could not rescue its banks without devastating political consequences. What followed was not recovery but submission. Because once survival depends on external rescue, sovereignty becomes conditional. And Europe was about to learn the true cost of being inside a system it did not control. When the immediate panic subsided, Europe faced a decision that would define the next decade of its history. Its banks had survived barely, its currencies were still standing, but the bill had arrived. Unlike the United States, which moved swiftly to recapitalize its financial system and absorb losses at the federal level, Europe chose a different path. Not because it was wiser, but because it was constrained. The European Union was not a single country. It had no unified treasury, no shared debt instrument, no central authority capable of acting decisively in a crisis. And so, instead of saving banks directly, Europe transferred the burden of rescue onto its nations. Private banking losses were quietly converted into public debt. Governments guaranteed failing institutions. Emergency loans were issued. Balance sheets that once belonged to banks were absorbed by states already stretched thin. What had begun as a financial crisis now became a sovereign debt crisis. This transformation was catastrophic. Countries like Greece, Ireland, Portugal, Spain, and later Italy found themselves trapped. Their debts exploded overnight, not because of reckless public spending, but because they had been forced to rescue financial systems far larger than their own economies. Ireland, a country of just a few million people, assumed banking liabilities worth several times its GDP. Greece inherited debts that were mathematically impossible to repay. Spain and Portugal were pushed toward the brink, and once the markets sensed weakness, punishment followed. Interest rates surged. Bond yields spiked. Refinancing became impossible. Europe's response was austerity, under pressure from creditors, central banks, and political partners. Struggling nations were forced to cut spending precisely when their economies were collapsing. Wages were slashed. Public services were dismantled. Pensions were reduced. Taxes rose even as unemployment exploded. This was not economic recovery. It was economic contraction by design. The logic was brutally simple: restore market confidence at any cost. Balance budgets, prove discipline, show that Europe would honor its debts no matter the human consequences. The results were devastating. Entire generations were lost to unemployment. Young people fled their home countries in search of work. Small businesses collapsed. Suicide rates rose. Trust in democratic institutions eroded. And yet, the debt did not shrink, because austerity suffocated growth, making repayment even harder. Economies trapped in recession cannot generate the revenue required to escape debt. Europe entered a vicious spiral, cutting deeper, falling further. Meanwhile, across the Atlantic, the United States was recovering. Its banks had been recapitalized early. Its central bank flooded markets with liquidity. Its government borrowed cheaply and stimulated demand. Growth returned faster than anyone expected. The contrast was stark. America absorbed losses and moved forward. Europe internalized losses and fractured. What was framed as fiscal responsibility became a slow-motion collapse of social cohesion. The bailout that saved European banks destroyed European societies, and in the process, the continent surrendered something far more valuable than money. It surrendered control. Economic collapse never remains economic for long. As austerity hollowed out Europe's economies, it also hollowed out trust in governments, in institutions, and in the promise that democracy would protect ordinary people from systemic failure. The political consequences were explosive. In country after country, voters reached the same conclusion: the system was rigged. Decisions that shaped millions of lives were being made not in national parliaments, but in distant financial institutions, central banks, credit rating agencies, and emergency summits held behind closed doors. Democracy felt performative. Elections changed faces, not policies. In Greece, the collapse was total. Traditional parties disintegrated almost overnight. Radical movements surged from the fringes to the center of power. The left promised resistance, the right promised order. Both fed on the same anger-humiliation. When Greeks voted against austerity, they were ignored. When they demanded debt relief, they were overruled. Their economy had become a case study in what happens when sovereignty collides with debt. Elsewhere, the pattern repeated. In Spain, youth unemployment hovered near 50%. An entire generation realized that no matter how educated they were, there was no place for them at home. New political movements rose directly from public squares and protest camps. In Italy, stagnation hardened into resentment. Technocratic governments replaced elected ones. Budget rules were enforced with religious devotion, even as growth disappeared. In France, Germany, and the Netherlands, the backlash took a different form. Anger turned outward. Immigration became the focal point not because it caused the crisis, but because it was visible, tangible, and politically exploitable. Populist parties surged. Nationalism returned. The idea of Europe as a shared project began to fracture. The European Union, once seen as a guarantee of peace and prosperity, was increasingly viewed as an enforcer of suffering. The phrase "Brussels decides" became synonymous with powerlessness, and beneath all of it lay a single corrosive belief that sacrifices were demanded from the many to protect the few. Banks survived, financial elites recovered. Ordinary citizens paid the price. This perception, whether fully accurate or not, was politically fatal. Once people believe the system exists to serve itself, they stop defending it. The crisis didn't just radicalize voters, it radicalized reality. Conspiracy theories flourished. Trust in expertise collapsed. Compromise became weakness. Politics turned tribal, the center hollowed out, and through it all, the original cause of the crisis, the hidden dollar bailout that stabilized America, remained largely invisible to the public. Europe blamed itself. Europe blamed its neighbors. Europe blamed its migrants. But it rarely named the structure that trapped it. A system where power flowed through currencies, not ballots. Where survival depended on access to money you could not create. Where economic rules were enforced without democratic consent, by the time stability returned, something irreversible had happened. Europe was no longer just poorer. It was divided psychologically, politically, and morally, and the shockwaves were only beginning to spread. Every crisis creates victims, but it also creates beneficiaries. While Europe struggled through a lost decade of stagnation, austerity, and political fragmentation, the global balance of power was quietly shifting, and at the center of that shift stood the United States. The hidden bailout that stabilized the dollar system did more than prevent collapse. It reshaped the financial hierarchy of the world. As capital fled European markets, it flowed into American assets at an unprecedented scale. U.S. Treasury bonds became the ultimate safe haven. Demand surged, yields fell. Washington found itself able to borrow vast sums at historically low costs. America didn't just survive the crisis, it monetized it. Wall Street recovered faster than anyone predicted. U.S. banks, recapitalized early and aggressively, emerged larger, more concentrated, and more powerful. Global finance reconsolidated around New York, while London, once the unquestioned hub of international capitals, its dominance steadily erode. The dollar's supremacy deepened, because when panic hits, the world doesn't ask which system is fairest. It asks which system is safest. And safety meant access to the Federal Reserve. The crisis taught global investors a brutal lesson. In moments of extreme stress, only one central bank truly matters. Not because it is morally superior, but because it controls the currency everything else depends on. Europe learned this too late. Its institutions were built for stability, not emergency. Rules designed to prevent inflation became shackles during deflation. Legal frameworks meant to avoid moral hazard ended up guaranteeing mass unemployment instead. Meanwhile, the United States rewrote the playbook. Quantitative easing, once unthinkable, became normal. Massive balance sheet expansion was reframed as responsible policy. Fiscal deficits no longer carried the same stigma. Growth returned, and with it, confidence. Europe, by contrast, internalized restraint as virtue. Even after the worst had passed, fear lingered. Fear of inflation, fear of debt, fear of repeating the past. Investment remained weak. Public spending stayed limited. Structural damage hardened into permanence. The gap widened. American tech giants rose to global dominance. U.S. capital markets became deeper, faster, and more innovative. Europe watched as its brightest talent migrated not just physically, but financially. This was not conquest by force. It was conquest by design, a system where crisis response determined future power, where flexibility beat discipline, where survival favored those who could act firsthand without permission. The irony was devastating. Europe had sacrificed growth to preserve credibility. America sacrificed credibility to preserve growth. Only one of those choices built the future. And by the time Europe recognized what had happened, the hierarchy was already set. The bailout that saved America didn't require speeches. It didn't need treaties. It didn't even need public approval. It simply worked. And in doing so, it ensured that when the next crisis arrived, the rules and the power would already be written in Washington. History often pretends that empires fall because of weakness. The truth is more unsettling. They fall because they cling to systems that no longer serve reality. The crisis that saved America and devastated Europe was not the result of a single bad decision or even a single country's failure. It was the outcome of a global financial architecture built on hierarchy rather than balance, on access rather than fairness. At its core, the story is simple. Modern power does not reside in armies. It does not reside in parliaments. It resides in the ability to issue the currency everyone else depends on. The United States did not win the crisis because it was wiser or more disciplined. It won because it controlled the dollar and, therefore, controlled time. Time to stabilize banks. Time to absorb losses. Time to let inflation do what austerity could not. Europe had no such luxury. Bound by rules, treaties, and a moral obsession with discipline, it chose to protect symbols over systems. It defended the idea of credibility while allowing its productive base to decay. It preserved balance sheets while sacrificing balance in society. And when the reckoning came, the cost was not evenly shared. The young paid with lost futures. The working class paid with lost security. Entire regions paid with permanent decline. What makes this story especially dangerous is that it was never truly resolved. The structures that caused the crisis still exist. The dollar remains dominant. Global finance still depends on U.S. liquidity. Europe remains constrained by rules designed for a world that no longer exists. And the lesson that should have been learned, that economies exist to serve people, not ledgers, was only partially absorbed. Instead, the world internalized a darker truth. That survival in modern crises is less about justice than positioning, less about virtue than leverage, less about democracy than access. This is why the next crisis will not be a surprise, because the incentives remain unchanged. When panic returns, capital will again flee toward safety. Central banks will again choose who gets rescued first. Governments will again face impossible trade-offs between markets and citizens. And once again, the public will be told that there was no alternative. But history tells us otherwise. The alternative existed. It was simply never chosen. The secret bailout that saved America and broke Europe revealed something profound, that the real dividing line in the modern world is not between nations, but between those who control the system and those forced to live inside it. And until that imbalance is confronted, crises will continue to do what wars once did. They will rearrange power, they will rewrite hierarchies, and they will leave scars that last far longer than the emergency itself. Because when an economy forgets who it exists for, collapse does not arrive as a single moment. It arrives as a decade, and by the time the damage is visible,